mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone, welcome to the Poole Locke YouTube channel. I am James Locke. Today we're going to continue answering some Ask James questions of the day. First question from Carl. He asks, hey, you talk a lot about stocks and dividend-paying stocks, but my wife and I are very conservative and we really don't want to put a lot of money in the stock market. So does your philosophy still work? All right, Carl, absolutely. In fact, it works even more in what I call the world of bond and bond-like instruments. If you think about it, right? Because you don't typically buy those things for growth. Now, if you're smart about it, you can, and realize that you might get a portfolio of what I call bond and bond-like instruments, with a manager, somebody who's an income specialist, and get, let's say, 5% income after fees. So maybe you're 6% gross, 5% net. Now those bonds, bond-like instruments, generally speaking, may not trend upward. Okay, but remember the dollar cost averaging conversation, right? They don't need to trend upward for you to get capital appreciation. In addition to the income, they just need to be volatile, right? And if you're reinvesting that income, then in the years that the bond and bond-like instruments are higher, then you're not buying as many shares, right? But you're increasing your future income a little bit less, right? But in the years where the bond and bond-like instruments are lower, then you're buying more shares, so you're increasing your future income at a more rapid pace. So the reality of it is you're better off in that situation with the bonds and bond-like instruments when you have that volatility. So you actually get, maybe you can get, a 4% income return and 2% growth, or you can get 7% total return without growth-based investments at all, just by the dollar cost averaging. Unlike dividend stocks, which over time should go up in value. So now if you're getting an average return of say 10% in the stock market, or a 7 or 6, 6 or 7%, outside of the stock market, well, heck, a lot of people, they'd rather not take all the risk of the stock market and get 7%. So again, I think you're smart to be thinking conservatively, especially if you've saved enough. If you and your wife are sitting there saying, hey, we've saved enough money to win the game of life, maybe you're retired and you're doing fine. Or maybe you're close to retirement and you know that, hey, I've saved enough. I'm going to be okay. Well, then good for you. By taking that risk reduction, letting the math work for you, truly, you're an income first, growth second investor, right? If you let the math work for you. Now, let's dive a bit deeper into this kind of conservative approach to investing for income. One key advantage of focusing on bonds and bond-like instruments is the predictability of income. When you buy a bond, you generally know exactly how much income you'll receive and when you'll receive it. Now, this can be, incredibly valuable for retirement planning, allowing you to kind of match your income stream with your expected expenses. Another option to consider in this conservative income-focused strategy is high-quality preferred stocks. These often provide higher yields than traditional bonds while still offering more stability than common stocks. They're a step up in the risk from the bonds, but still generally less volatile than the broader stock market. Don't overlook the potential of annuities in a conservative income strategy either, right? Whether, while they're not kind of right for everyone, certain types of annuities can provide guaranteed income for life, which can be a comforting foundation for a retirement income plan. It's also worth mentioning that even within a conservative strategy, diversification remains important. Consider spreading your investments across different types of bonds, government bonds, corporate bonds, municipal bonds, right? Perhaps even some international bonds to kind of reduce overall risk. Lastly, remember that being conservative doesn't mean being completely risk averse. Inflation is a real risk to conservative investors, potentially eroding the purchasing power of your income over time. To combat this, you might consider allocating a small portion of your portfolio to assets with growth potential, or look into Treasury inflation protected securities tips, which adjust with inflation. Carl, thank you so much for sending in your question. Your conservative approach can absolutely work within an income-focused investment strategy. The key is to find the right balance that provides the income you need while aligning with your risk tolerance and long-term financial goals. Thanks for the awesome question. And hey, if you would like to send in your question and get it answered here on the show, you can email it to us at poolelock@poolelock.com. Moving on. Second question. We have an email from Frank. He asks, my wife really wants to have another home in a warmer climate as the winters are brutal in Vermont. So how do I know if I can really afford this? Well, I love it. I love Vermont. I go skiing up there all the time, but I get it. It's cold. So, if you want to have some lump sum goals, where you want to spend some chunks of money in retirement, there's also income goals, and you want to have the legacy, right? What's the recommendation, right? Well, Frank, it depends if you have enough money to generate income for retirement, even after you've covered the lump sum goals, right? Then I don't think anything's changed, right? You could take your lump sum goal money and you could, maybe go buy some CDs or things like that. Okay, so assuming you're close to retirement or retired and have that kind of set aside for those lump sum goals that you're going to spend all that money down, and just have the rest of the money generating income. Right? So I think that could work. If you need more growth to get those lump sum goals, then you might have to focus more on high dividend common stocks versus bonds and bond-like instruments, because you actually do want the G component, the growth component, in addition to the income. Now, if on the other hand, Frank, that you say, okay, well, I've got that covered. I want to leave a legacy. Now the question is, do you want to leave that legacy, or do you want to protect it, or do you want to grow it? And again, if you want to grow the legacy to leave more for your family, then you want to be a little bit more heavily weighted toward high dividend stocks. That might work because now you can still get a decent income and you can grow your money for the next generation. However, if you say no, I just want to protect it, okay, well then you can weigh it heavily towards bonds and the bond-like instruments, get enough income and protect your principal. And remember, Frank, that you can always get a little bit more income through bonds and bond-like instruments than you can through high dividend stocks. So the other part of the equation is, do you have enough to kind of generate the income you want plus a little extra wiggle room? That may allow you to be a little bit more growth oriented in addition to the income if you want. But if you don't, if you're cutting it close, then you have to look at more bonds and bond-like instruments, which means you may not have a lot of growth potential. And if you try to get that growth potential, guess what? In the markets, if the markets don't cooperate, you may get stuck working longer. So whatever that kind of lump sum goal is, Frank, that you have down the road, it's important. Is it important enough so that if things go backward on you, that you're willing to work a few more years to get it? That's the question that I'd encourage you to ask yourself. Now let's dive a bit deeper into this multifaceted approach to retirement planning and investing for income. Your situation, Frank, illustrates a common challenge balancing current income needs, future lump sum expenses, and legacy goals. It's a juggling act that requires careful planning and potentially a diversified investment strategy. For your lump sum goal, consider a bucket strategy, right? This involves setting aside specific amounts of money for each goal in separate buckets. Each bucket can be invested according to its time horizon. For nearer term goals, as mentioned earlier, CD short-term bonds might be appropriate. For goals further out, that's where you might consider a mix of bond and dividend-paying stocks to potentially capture some growth while still focusing on income. Regarding your income goals, a laddered bond portfolio could be an effective strategy. This involves buying bonds with staggered maturity dates, providing a steady stream of income while also offering some protection against interest rate fluctuations. Now, you could complement this with a portfolio of dividend-growing stocks, which can help your income keep pace with inflation over time. For your legacy goals, you might want to explore more tax-efficient strategies. For instance, Roth IRA conversions could be beneficial as they allow your investments to grow tax-free and can be passed on to your heirs without requiring minimum distributions, RMDs. Another option could be life insurance policy. That can provide tax-free death benefit, big lump sum death benefit to your heirs. Remember, Frank, that these different goals don't have to be addressed with completely separate strategies. A well-diversified portfolio can serve multiple purposes. For example, a portfolio of high-quality dividend-growing stocks could provide current income potential, and so you get current info, and then the potential for capital appreciation to meet future lump sum needs and a growing legacy for your heirs. Last, don't forget about the importance of regular reviews and adjustments. As you move through retirement, your goals and needs may change, and your investment strategy should evolve accordingly. Working with a financial advisor who specializes in retirement income planning could be an invaluable navigation path for these complex decisions and ensuring your strategy remains aligned with your goals. Hey, Frank, complex question to be sure. Thank you so much for sending it in. That multifaceted approach to retirement planning shows foresight and care for both your own future and that of your family. So with careful planning and a focus on income-generating investments, you can work towards achieving all of these important goals. Hey, great questions today. Thank you, Frank. Thanks for the awesome question. If you would like to send in your question like Frank did, you can email it to us at poollocke@poollocke.com. If you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. We'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.